Welcome to Online Trading Campus. Welcome to our OTC Futures course, Module 1, Fundamental Awareness. In Lesson 3, we will dive into the global futures markets. In this lesson, we will first spend some time exploring the biggest futures exchanges in the world and the markets that can be traded on those exchanges. Since we have so many different futures markets, we also go through a classification process so you have a very clear overview of the variety of markets that can be traded in the futures market. One of the advantages of trading futures is that there are central futures exchanges to trade on. Having a central exchange allows for transparency in price for all to see, a central gathering place to execute orders via electronic trading, and most helpful, direct access to the venue to execute your trade. Now, only on a side note and FYI, if a trader is not aware that some futures products are traded on multiple exchanges, then they may route their order to the wrong exchange. This happens if you use the wrong symbol and if you're subscribed to multiple exchange data. With the word wrong, I mean in quotation marks wrong, I'm simply saying that the exchange your order ends up on may be the one with the least amount of liquidity. Some of the products that I'm referring to are, for instance, WTI crude oil, sugar, coffee, and cocoa. In the United States, there are two futures exchanges, the Chicago Mercantile Exchange Group, CME, and the Intercontinental Exchange, ICE. The CME Group is the largest futures exchange in the world. It offers the world's widest range of futures. In 2017, a daily average volume of 16.3 million contracts was recorded, which counts for a monthly average of 358 million contracts. Just to put this into perspective with one or two contracts that you might be trading. Roughly 95% of the markets that we are traded through the CME Group. So basically, we only require a subscription to the CME data. I will show you how you can easily find what markets are traded through which exchange and explain how to subscribe to exchange data in a minute. ICE operates 12 exchanges. This includes ICE futures exchanges in the United States, Canada, and Europe. In 2016, a daily average volume of 8.5 million contracts was recorded, which counts for a monthly average of 170 million contracts. So you see it's significantly smaller than CME Group, but still massive. Again, this part is only for your information, but interestingly, the New York Board of Trade, short NYBOT, where soft commodities are traded. What are soft commodities? Well, these are sugar, coffee, orange juice, etc., was located in the World Trade Center. So the NYBOT was the largest volume exchange for these soft products. After 9/11 though, the exchange was moved to temporary housing. Soon after that, ICE acquired all of the trading products on the NYBOT, therefore giving ICE the largest volume contracts for soft products. The New York Mercantile Exchange, the NYMEX, is another exchange located in New York, but they are primarily known for trading energy products. The CME acquired all of the other futures exchanges in the United States, making it the largest futures exchange in the world. During these acquisitions, they obtained the NYMEX, where the majority of its trading volume is done in the energy sector. NYMEX also has some soft products, but they have very little volume and should not be traded by us speculators. A trader wishing to trade some of the soft futures should be trading the ones on the ICE exchange. Here the volume is sufficient to allow a trader to get good trade executions when placing orders. But again, I will make life easy for you to show you all of that. And then last but not least, we have the Eurex. The Eurex is Europe's financial exchange and is operated by Deutsche Exchange AG. 2017, a daily average volume of 4.4 million contracts was recorded, which accounts to a monthly average of 88 million contracts. You can see how much smaller the Eurex is compared to the US exchanges. The Eurex is really only interesting if you want to trade some European markets, like the DAX for instance. Let me now first show you how you can see what markets are traded on which exchange. Therefore, we go on the TradeStation website. There's one particular reason why we want to trade futures with TradeStation. I will come to that point in Module 2. but everything I'm going to show you is based on TradeStation requirements because they make life really easy for you when it comes to futures trading. So the TradeStation website is tradestation.com. You hover over pricing and go to futures margin rates. Please also bookmark this particular site. The information on that site you might need quite a few times. You will find all the futures markets you can trade with TradeStation, the specific symbol route and the various margins. But this is something for module 2. We will now quickly explore the markets you can trade with TradeStation and in particular on which exchange they are traded on. All the indices are CME based markets, so you have to subscribe to CME data here. Except, as you can see, the European markets, you require Eurex data. So if you want to trade the DAX or some of the European treasuries, you have to subscribe to Eurex data. All the currencies are traded, as you can see, through CME, except the dollar index. The dollar index is traded through ICE only. Interest rates are traded through CBOT, which we learned is a CME entity. So you need CME data for that. Metals are all COMEX and NYMEX. Also these two exchanges are part of CME group. So also here you need CME data. Only if you want to trade the mini contracts you need ICE data. Energies like crude oil or natural gas are NYMEX, which is also part of CME group. So for energies you need CME data as well. All agriculture products are CBOT, which is part of CME group as well. Meats are also CME based. And only softs, as mentioned in the beginning of this lesson, you have to trade through ICE. So if you want to trade coffee, cotton, frozen orange juice, cocoa or sugar, you require ICE data. So now, where can I subscribe to exchange data? Let me show it to you quickly. You go again on the TradeStation website. You log into your account. Obviously, you need to open an account first with them if you haven't done that yet. Go to Client Center, go to Customer Profile, click on Software and Data Subscriptions, and here you can subscribe to all the data. The Globex Value Bundle, which consists of all CME Group live data, as you can see here, should be for free. If it is not for free, please contact TradeStation and tell them you want the data for free. They give you the data for free, but then you have to pay a little bit more commission per contract that you trade in your live trading account. You have to see what makes more sense for you. I think, if I'm not mistaken, if you go for paid subscription, which is $20 per month on the Globex bundle, then you get cheaper commission on each contract you trade. Anyways, please contact TradeStation to get more information on that. Ideally, as I said, the data is for free. The Eurex delayed data is just for analysis purpose. What we are using in the live trading sessions to analyze the DAX is $10. If you require the live data, it is $18. I have subscribed to the delayed data to analyze the product through TradeStation. Trading wise, I trade the DAX through equity as a CFD. This is because of margin, something that we will explore later on in this course. Same is applicable for ICE data. The delayed data here is for free. But if you want to trade US dollar index, coffee, cotton, frozen orange juice, cocoa or sugar through futures, you have to pay $126 for ICE data subscription on a monthly base. I honestly have never seen a reason why to subscribe to the live data. These markets are all available as CFDs either through Rwanda or equity. Since the delayed data is for free, that's all we need for analysis purpose. Since the delay is only 15 minutes and we anyway trade only weekly and monthly income. So that's the data part. Let's continue with the markets you can trade. As a futures trader, you have a choice to trade a huge variety of futures markets. Most new traders starting out in futures typically trade financial futures simply because they were already trading equity products like stocks or ETFs before coming into the futures arena. Note, however, as we have seen already, there are many different futures markets. Let's break down all of these different markets into 5 groups. I will give you a clearer picture of what you might be getting into. I will also try to help you decide which type of futures may be your markets of choice. Generally speaking, like the stock market where there are over 8,500 stocks listed to trade, the futures market has many hundreds of contracts. And just like the stock market, traders will not trade all the available futures markets. You should look for markets that have good liquidity, in other words, volume, fair bid and ask spreads for entering and exiting trades. We will discuss this more in detail later in this course, but in another module. Obviously, you should also have a good understanding of the market you're trading. Unfortunately, not all futures markets should be traded by speculators. For example, there are futures contracts for uranium, butter, whey, lumber, black seaweed, real estate, and even weather markets. Those markets are used by commercial traders to hedge price risk of the physical commodity that they own or wish to own later. We, as speculators, want to avoid these types of low liquidity markets for risk management purpose. However, there are many other types of future contracts to choose from. First group, equity indices. Equity index prices are affected by how the stock market is performing. As stocks come under selling pressure, so will the equity indices. The reverse is true for buying pressure. Interest rates can have an impact on equity indices as well. Higher yields in those products creates competition for money searching for safer investments. Second group, interest rates. Interest rate prices and yields can be driven by several factors. An expanding economy in a country might give their central bank reason to believe inflation is near. They will then begin to raise interest rate yields to slow the expansion. If a country's economy is contracting, then their central bank may lower interest rate yields in an attempt to stimulate their economy by making borrowing cheaper, allowing companies to grow their earnings again. Third group, energy and metal. Energy futures contracts are the highest demand commodity we have. Crude oil on its own is one of the world's most liquid markets. Byproducts of crude oil are gasoline and heating oil. Depending on the time of the year, crude oil demand is determined by a few seasonal and fundamental factors. In early spring, the demand of gasoline begins to build for the summer holiday driving season. In the fall, the demand shifts towards heating oil to warm homes in the cold winter month. However, other factors such as refinery fires, shutdowns, etc. can disrupt supply distribution and cause price reaction too. The natural gas market is a very seasonal market as well. As with heating oil, natural gas is used for heating homes in the winter. In addition, it is also used for air conditioning units used in very large buildings such as manufacturing plants. Vehicles at the commercial level, FedEx, UPS, US Postal Services, etc., are also beginning to use more natural gas. Metal markets are very diverse as well. Here you will find gold, silver, copper, and platinum. Gold prices can be driven by seasonal factors, with early fall usually beginning a low demand time for gold right before we head into the higher demand times of the India wedding season, holiday gift giving, and then the Chinese New Year holiday. Gold is primarily used for jewelry more than as an industrial metal. Central banks around the world keep gold in their vaults to hedge against any potential inflation that may come. Silver, copper, and platinum are additional types of industrial metals. Copper can be impacted by the housing market due to the amount of copper used to build a home. The summer building season usually brings about higher prices for copper. Platinum is used in catalytic converters in automobiles and jewelry as well. Warning auto sales can obviously have an impact on platinum prices. Silver has some industrial metal value as well and is also used to hedge against any potential inflation that may come. Fourth group, FX or currency. Currency market prices can be impacted by interest rates around the world. Capital tends to move to currency markets whose countries have the highest yielding interest rates. Geopolitics can have an impact on currency prices too. A strong, well-run government will make investors feel safer investing in that country's currency compared to a country whose government is in turmoil. Fifth group, agriculture. Agricultural products can include grains and livestock. Both of these are heavily influenced by seasonal patterns that can make price go up or down. With grains, they tend to be planted and harvested at the same times each year. This creates a well-known seasonal pattern of higher prices in the spring than in the fall when supply causes lower prices. Livestock is another seasonal commodity. From the supply side, hogs and cattle are bred and slaughtered at the same month each year, while summer grilling season increases demand. Certain times of the year also cause more demand for pork than beef, and this contributes to price swings. Grains can be affected by weather. Too much rain can be as bad as not enough. Too early for a frost can ruin a crop. Diseases in the crops can ruin a good year of planting. So while grain traders follow the seasonal patterns, they must also be aware of weather conditions. Softs are commodities like sugar, cocoa, coffee, orange juice, cotton, and lumber. Most of these have low volume and are not usually traded by smaller traders. However, they are commodity products that we use every day of our lives, and that means that the fundamentals of supply and demand still impact these products as well. Sugar is one of the few commodities that grows in both hemispheres simultaneously. There is sugarcane and sugar beets depending on the region of the world you are in. The largest producer and exporter of cocoa is the Ivory Coast of Africa. Frequently, civil wars in that region have impacted the price of cocoa. There have also been many times when a labor strike caused price to rally. This emphasizes how one primary production point can impact prices and increase risk. Coffee is a product of mostly South America and Vietnam, but is grown in other areas of the world as well. The winter months of the Northern Hemisphere are the highest demand times for this product. So these are all the markets that we can trade at a glance. In the equity index group, we have the S&P 500, Nasdaq, Dow Jones, Russell, Euro Stoxx 50, the German DAX, the Nikkei, and CME Bitcoin. Bitcoin is not an equity index obviously, but falls under the index group. In the interest rate group, we have the 5-year Treasury note, the 10-year Treasury note, the 30-year bond, the 10-year bond, and the 30-year bubble, which are two German markets. In the energy and metal group, we have crude oil, natural gas, gold, copper, silver, heating oil, platinum, and palladium. In the FX currency group, we have euro, Japanese yen, Swiss franc, British pound, Australian dollar, Canadian dollar, New Zealand dollar, Mexican peso, and the US dollar index. We will look into the difference between FX futures and FX spot later in this course more in detail. I've created a separate lesson for that. In the agricultural group, we have corn, soybeans, wheat, coffee, cocoa, cotton, sugar, cattle, and lean hogs. We will look at all these single markets throughout the entire course. I will show you the different margin requirements, different tick values, the contract months that are being traded, the symbol route for each market, and of course, we discuss seasonality and correlations between these markets. So stay tuned for Module 2.